Hello everybody, my name is Bernicke and I'm going to be doing your monthly market update for July, and today I wanted to talk a little bit about the economy. And when we talk about the economy, of course it's always important to look at real estate because that's one big portion of what makes up our economic health in this country. Right now I would like you to just pay attention for 1 second to this graph on the left. And what this shows us is it shows us the amount of housing inventories on the market. And you can see, compared with where we've been the last 40 years, today the housing inventory is very low. In addition to the housing inventory being very low, if you look over here, the rental vacancy rates are also very low. So we've got a lot of people looking for homes, whether they're going to rent or build or buy a home, and not a lot of inventory to be able to provide that to people. So that would imply going forward in the future that, at least for the foreseeable future, the real estate market should maintain some strength with all things being equal. Outside of the real estate market, it's also important to take a look at how the consumer is doing. So when you look over here, this measures household debt service ratio the last 40 plus years up until today, and you can see people's ability to service their debt has gotten a little bit worse. The lower we are on the scale, the more likely consumers are able to pay off their debt. And so it has gotten worse a little bit here recently, but we're still well below the historical average when compared with where we've been over the last several years, which is a good sign as it applies to consumers being able to pay off their household debt. In addition to that, the amount of delinquencies on auto and credit card loans has been going up, as you can see over on this chart to the right, but we're still relatively in a good place compared with where we've been historically speaking. In addition to looking at that, I think it's also important to look at the revolving consumer credit outstanding. And basically, revolving credit could include things like credit cards and home equity loans. And if you look at the collective total of revolving consumer credit, you can see we're at a very high point, which would imply, generally speaking, that has a negative context. However, it's important to put that into context from the perspective of, okay, revolving credit is going up, but what's happening to people's income during the same time frame? With this graph, it goes all the way back to the year 2000. And when we look at that, we can see that there has been a spike recently. Again, lower is better. So this measures revolving consumer credit outstanding as a percentage of disposable income. So basically what this means is, yes, the credit outstanding has been going up, but income has actually been going up faster than the credit has been going up. So people's ability to pay off that credit, should they decide to use it, has actually in a place that's far better than where we've been pretty much over the last 20 years, with the exception of the last few years. So the trend isn't going in the right direction, but overall this would imply that the consumer is still healthy. So depending on who you talk to and who you ask, either we are headed for a recession or we are not. These are a few signs that would imply the consumer is healthy, the real estate market is healthy, and those are good things going forward. So of course we'll keep you up to date with any new developments going on in the real estate markets, in the economy, or with the consumer. But if you have questions in the meantime, feel free to reach out to us, 715-832-1173. That wraps up your July market update. Thank you.